Disclaimer: this video is created for educational and informational purposes only. It should not be taken as financial, investment, or legal advice. Always conduct your own research or consult a qualified financial professional before making decisions related to money, investments, or financial planning. Banks. We trust them with our savings, our salaries, even our dreams. But have you ever stopped to ask yourself, how do banks actually make money from us? Welcome to Money Mindset, where money finally makes sense. We turn complex financial systems into simple, visual stories that help you understand how the world really works. Let's dive in. Imagine this: you walk into a bank, open a savings account, and deposit $1,000. The bank smiles, thanks you for your business, and maybe even gives you a small interest rate, like 1% a year. Sounds fair, right? You're thinking, cool, my money's growing. But here's the twist. The bank isn't just keeping your $1,000 safe. It's about to make money off your money. Because the moment you deposit your cash, that money doesn't just sit in a vault. The bank lends it out. Maybe to someone buying a car. Maybe to someone getting a mortgage. Maybe to a business expanding its operations. That $1,000 of yours can be multiplied and re-lent across the economy. A process called fractional reserve banking. In simple terms, banks are only required to keep a fraction of your deposit on hand, say 10%, and they can lend out the rest, so your $1,000 becomes $900 in a loan. That $900 is then deposited somewhere else, and 90% of that is lent out again. This cycle repeats, and suddenly, that original $1,000 has turned into several $1,000s circulating in the economy. It's like money magic, except it's not magic at all. It's banking. Now, here's the key. Banks make money from the spread. The difference between the interest they pay you on your savings and the interest they charge borrowers. Let's say your savings account gives you 1% interest, but your bank charges 7% on a car loan. That 6% gap, the spread, is where banks make their real profit. And when you multiply that across millions of customers and billions of dollars, it adds up to massive earnings. But that's not all, because modern banks have become fee machines. Every overdraft charge, every ATM fee, every credit card late payment, that's income. Even when you're just holding money, your bank might be collecting revenue from your transactions, or even selling anonymized data about your spending habits. That's right. Your spending data has value too. It tells the bank what you buy, when you buy, and even how financially healthy you are. In the age of digital banking, information is money. So, the traditional way banks make money, lending, still exists. But it's no longer their only gold mine. Today, much of their profit comes from services, fees, and financial products that most people barely notice. Let's break down the main ones. 1. Loans and credit cards. When you take a loan or use a credit card, you're borrowing money that isn't really there. It's created through the fractional reserve system, and you pay interest on it. Credit card interest rates can reach 20% or more. So while you think you're borrowing convenience, the bank is earning double-digit returns on money it created from your deposit. 2. Fees and penalties. Overdraft fees, wire transfer charges, foreign exchange fees, late payment penalties. These small amounts might look harmless, but they're huge revenue sources. In the US alone, banks earn tens of billions every year from these hidden costs. 3. Investments. Banks don't just lend money, they also invest it. They buy government bonds, corporate debt, and even trade in financial markets. The returns on those investments contribute to their profits, often backed by your deposits. 4. Asset management. If you've ever used a bank for investment or wealth management, you've likely paid management fees. These can be annual, performance-based, or transaction-based, and they generate consistent, passive income for banks. 5. Cross-selling. Ever noticed how your bank tries to sell you insurance, investment plans, or credit cards every time you log in? That's called cross-selling. Each product you buy ties you deeper into their ecosystem and earns the bank another revenue stream. But here's where it gets interesting. Banks don't just make money from you. They make money because of you. Your trust in the bank, your willingness to deposit and borrow, your confidence that your balance means something. That's the foundation of the entire system. Without customer deposits, banks couldn't lend. Without lending, they couldn't generate interest. And without trust, the entire financial system collapses. Just like we saw in the 2008 financial crisis. Remember that? Banks had been taking risks with people's deposits, lending to risky borrowers, packaging those loans into complex financial products, and selling them as safe investments. When trust vanished, the system froze, and governments had to step in with bailouts to keep it from collapsing. So, what's changed since then? In some ways, not much. Banks are still profit-driven businesses, but the modern version is far more digital and far more psychological. When you use a banking app, swipe your card, or send a transfer, the system records your behavior. Algorithms predict how likely you are to default, how much you'll spend, and which products to offer you next. In other words, banks don't just make money from your balance. They make money from your behavior. That's why loyalty programs, credit score tracking, and personalized offers exist. They're designed to keep you engaged, predictable, and profitable. Let's zoom out for a second. 100 years ago, banking was about safekeeping. You deposited money because you wanted it protected. Today, banking is about monetization. You are no longer just a customer. You're a data source, a borrower, and a revenue stream. But here's the part most people miss. That's not necessarily a bad thing. Banks provide essential services, payments, loans, investments that keep economies moving. Without banks, businesses couldn't grow, mortgages wouldn't exist, and the financial system would grind to a halt. The problem isn't that banks make money, it's how transparently they do it. Most people have no idea what really happens to their deposits once they hit the bank's balance sheet. So how can you protect yourself, or even take advantage of the system? First, understand that your savings account isn't making you rich. If your interest rate is below inflation, and it usually is, your money is losing value in real terms. Consider moving excess savings into higher yield options like certificates of the deposit, money market funds, or safe investments. Second, pay attention to fees. Those $5 and $10 charges add up over time. Compare banks, switch accounts, and look for fee-free or digital alternatives. Third, if you use credit cards, do it wisely. Pay in full each month to avoid interest. Remember, every dollar of credit card debt earns the bank money, not you. And finally, think critically about loyalty. You don't owe your bank your business forever. If another institution offers better terms, more transparency, or better digital services, switch. Your money deserves to work for you, not just for them. Here's the takeaway. Banks make money by lending your deposits, charging interest, collecting fees, investing, and monetizing your data. But behind all that complexity lies one simple truth. Banks profit from your trust. As long as you believe your money is safe, the system works. When that belief fades, everything changes. So the next time you open your banking app or swipe your card, remember, you're not just moving numbers. You're participating in a financial story built on trust, leverage, and psychology. And the more you understand that story, the smarter your decisions become. If you enjoyed this video, hit like and subscribe to Money Mindset, where we make financial education clear, visual, and fun. Tell us in the comments, What surprised you most about how banks actually make money from you? Disclaimer: this content is for educational purposes only and reflects personal opinions, not professional financial advice. Viewers should conduct independent research or consult a licensed financial advisor before making financial decisions. The creator and this channel are not responsible for any losses or actions taken based on this content.